Hello everyone, welcome back to my channel. I'm your host Miss KK and this is The Wave. It is your weekly show that looks at topics related to personal, family and business finance. And our hope is that by the time we get to the end of these conversations, you are really better equipped to make sound financial decisions. If you're new here, thank you very much and welcome. And if you're already a returning subscriber, an awesome appreciation for always choosing to be part of this amazing community. Today we are back with yet another video and we are talking about the property market in Namibia. If you haven't done so, please check out our property folder. We've done quite a few videos on properties. I've done a video on the process to acquire your first property in Namibia. I've done a video on how to prepare for your home loan approval. I've done a video where I've shared my mistakes that I made in the property acquisition process. I've done a video on repo rate and how that affects your bond repayment. As well as more recently, I've done a video on rental cost consideration when you are looking to rent a property. And today I'm doing a video to help you understand this notion of whether renting is throwing away money, or alternatively put, whether buying is the best thing you can do with your money at a given point in time. This video I'm doing in response with what's happening currently in the global market, especially in relation to the property market. We are all aware that currently we are living in high inflationary times, and this is really as a result of the aftermath of COVID, worsened by the global political unrest between war and Russia that is rolling over to the global economy. I've also been watching a lot of news of late around the property market in Europe and in America, and analysts in that region seem to be focusing a property crash similar with what happened in 2008. If you are perhaps not around in 2008 or don't remember what happened, the property market crashed in 2008 and most homeowners found themselves in negative equity. So being in negative equity simply means that if you were to exit that property at that point in time, or you were renting that property, your rental was lower, significantly lower than the bond you are paying at the bank, or if you were to exit at that point in time, you would have to top up from the proceeds that you're getting from the sale of that property in order for you to settle the bank fully, meaning you are exiting that trade or you are exiting that sale at a loss. So they seem to focus that in 2023, we are heading into a similar trend, given a few factors that they're analyzing, and they're saying that all the conditions that preceded the 2008 crash are currently present, and therefore that's a reason why I am bringing this video today. I'm bringing it so that if you are in the property market, you understand what this means for you to determine whether you should exit or you should hold onto your property. And if you are entering the property market, you understand that you need to look at other factors instead of you just thinking renting is throwing away money and that is the primary reason why you are looking to buy the property, because that doesn't necessarily hold true all the time. There will be a time where it's favorable for you to buy a particular property, but there will also be a time where it's not favorable to buy a property, and that means renting would be the favorable option. So to start off with that discussion, I just had a few notes on my computer here. So if you see me looking at down here, I'm looking at the notes that I've made on my computer. This video isn't long. I'm just going to look at what's happening around the interest rate, and I'm going to analyze two properties that I saw being advertised recently to prove to you that renting is not always throwing away money, or it shouldn't be the main reason why you are buying a property. We need to get away from this obsession of you need to own a property, you want to be a title deed owner, to realistically looking at what is in the best interest of your pocket at that point in time. And also, I want you to start understanding that just because you don't have a property, it doesn't mean that you don't care about your future, or it doesn't mean that you're not making a wise decision. So snap out of that mind and look at these decisions objectively. You may agree or disagree with what I'm going to say in this video, and that's okay. Let's agree to disagree and let the conversation continue on other aspects. All right. Looking at the interest rate, right? Before 2020, the interest rate were in the region of about 10.5%. That was the prime rate. And because of the economy struggling with COVID, most government tried to respond by reducing interest rate to try and help consumers have more money in their pocket in order to stimulate spending in the economy. So interest rate dropped drastically from about from about 10.5% to as low as 7.5%. That unfortunately didn't last long because of the political unrest in Ukraine and Russia that led to high inflationary times, and governments also responded in the opposite direction by increasing interest rates to try and help consumer curb spending so that they can have a hold on inflation. However, that also meant that people that took debt around 2020, 2021, when interest rates were lower, are really finding it hard to accept that their bond repayments and car repayments are accelerating at such a steep rate, and are finding themselves with less disposable income, in addition to already high inflation prices across the economy. Food is going up, fuel is going up, electricity is going up. On top of that, bond repayments are going up. So we really can't afford to ignore the impact that interest rate has on bond repayments and the housing market in general. Therefore, you need to understand how this influences the property market if you have a house or if you intend to buy a house someday. So with that being said, I also want you to also think about what have happened to the rental prices and the property prices since the interest rate started increasing. Do you have a landlord who has hiked your rent repayments by 44%? Has your housing value appreciated by 44% over the last 2 years? The answer is likely to be no. So just because bond repayments are going up, it doesn't also mean it's going to have a one-on-one effect on rental repayments, nor is it going to have a one-on-one effect on the housing appreciation in general. So you need to bear that in mind. To help you analyze this property market situation and the rent versus buying arguments, I've looked at two properties in Namibia. One is in the northern part of Namibia, one is in Windhoek. I want you to look at these numbers in deciding that when you are buying a property, you ought to do a profitability assessment before buying a property, because some properties are relatively better off than other properties given the town that you are buying and the rental income it's likely to fetch. So we are going to be starting off with property number one, which is the property in Oshakati. So this property is being sold for 700,000, and it was advertised that if you were to rent it out, you would get a rental income of 4,500. So at face value, when I thought to myself, why would I buy that property if I can barely cover 50% of my bond with that rental income? So let's just assume you are a young professional, you don't really have a good credit history, or you don't have that much of a bad credit history, and the bank gives you 11.75% over a 20-year period, and because you are a first-time buyer, you opted for the zero deposit. So at a monthly basis, you will be paying the bank 7,585 in relation to the 4,500 rental income or rental payment you could have been making. So month on month basis, you will be out of pocket for choosing to buy this particular property. But let's look at this property over a 20-year period. So let's assume you rent this property out over a 20-year period. You start off with a rental income of 4,500. You increase it with 5% per year. And over the life of this property, which is the 20 years, because we are trying to determine the impact whilst you still have the bond, you would have recovered in terms of rental income 1.7 million. But you would have paid the bank 1.8 million in bond repayment excluding cost. So at face value, you would have been in a loss before taking capital appreciation into perspective, and also before taking into consideration other costs. So the other costs that we are talking about here are rates and taxes, since this includes water. So we are looking at rates and taxes, we are looking at electricity, we are looking at homeowner insurance, we are looking at household content, and we are looking at your life cover and potentially renovation. So do the math and say, if I'm already in a loss at face value, how worse off will I be for buying this property? So if you are to exit this property at any point in time before the 20 years, you will be at a loss. And you would have to hold this property for more than 20 years in order to break even. So you might even realize you might only start making profit on this property in year 30. So before you just think renting is throwing away money, think on that and whether it's actually worth your while committing to a property now. Because most of us commit to a property that we think is ideal for now. 2 years down the line, when we have kids, we realize we really can't make use of this property. It's not practical, or we get married and we want a bigger home and we want to exit, which means we are basically exiting at a loss. So then let's look at property number 2. So I thought maybe the North is just a special case. Let's look at Windhoek. Windhoek, I saw another property being sold for 800,000. Let's assume similar effect, 11.75% over the 20 years, zero deposit. On a monthly basis, you will be paying the bank 8.6 thousand per month. Relative to 6.5 rental income that was advertised, that is the potential rental income on this property. At face value, you are also still making a loss. And unlike the first property, this property was actually advertised with what the levies would be and what the rates and taxes, what the other taxes would be, and it amounted to at about 1.563 per month. So your rental income will still be lower than the bond repayment, and including these costs, you will be worse off. But this property, over the life of the bond, if you were to rent it out, increase your rental payment by 5% per annum, you would have made about 2.5 in terms of rental income in relation to the 2 million that you'll be paying the bank. However, that excludes these levies, and it also excludes the other costs that we've mentioned. So these other costs, if they stay constant, which is unlikely to be the case, they'll end up to around about 375,000. So take the 2 million you are paying the bank, take the 375,000 that you are paying to your body corporate or to your municipality, and on top of that, add your other costs, which is your, the insurance that we've spoken about, your household content, your fire cover, your life cover, and also renovation, and also now electricity. How long will you have to have this property in order to recoup your cost? So all I'm trying to say is renting might not be throwing away money over the next 20 years and even over the next 30 years. Or renting is not necessarily entirely bad like we make it seem. What also I want you to get out of this video is that you need to assess where you are in your life. Can you afford to rent at that point in time? Because it will be a long life commitment for you to go into a bond simply because you are throwing away money and you are helping someone else's pay their bond. Before you commit to a property, make sure that you do your profitability analysis. Make sure that you understand what you're getting yourself into. Make sure that you understand the other costs around the property, not just the bond that the bank quotes you, and make sure that you are honestly comfortable that you are going to stay in this property for long enough for it not to be a waste of money. Because if you go in either of these two bonds, you exit before the 20 years is over, and your property doesn't appreciate in value to make up for the losses because of the interest rate you are charged by the bank, you would have simply thrown away the money that you didn't want to throw away with the rent. So with that being said, ladies and gentlemen, thank you very much. I hope you now understand that it's not as simple as 1 + 1 is 2 in terms of property acquisition. It's not as simple as buying is bad, renting is bad. There are, other factors, and also most importantly, depending on the type of market that you are in, you could be getting into the market where interest rates are very high, and therefore you are going to start off with a high interest rate from the get-go, or you could have entered the market where interest rate is low and you need to factor into what would happen to my bond prices if interest rate were to start skyrocketing like they are currently at the moment. So I know it's all over the place, but this is really all I wanted to say in this video. Thank you very much for giving us your time. Hope you did take one thing or two from this video, and hopefully it opens up a new perspective in evaluating your property before committing. Until next time, it is goodbye. Please don't forget to like, subscribe, and share this video with your family and friends. And it is goodbye.